Welcome, curious minds, back to the deep dive. We're the place you come to, cut through all that noise and get straight to the insights that really matter. Today, we're jumping headfirst into the crypto world. You know how it is exhilarating, sometimes, frankly, bewildering, especially when we talk regulation. It often feels like this incredibly complex puzzle, constantly shifting, that the U.S. government is, well, actively trying to solve, sometimes pretty frantically. But under all those headlines and, the technical jargon, there's actually a strategy unfolding, and it's one that could really reshape how you interact with digital assets. We're zeroing in on a critical new development today. The U.S. Commodity Futures Trading Commission, the CFTC. They're back with another crypto sprint.
Now, it sounds like a race, doesn't it? And honestly, in a lot of ways, it really is a race for clarity, for structure in a market that just moves incredibly fast. But what exactly are they sprinting towards this time around? And maybe more importantly, why should you be paying super close attention? This isn't just, bureaucracy for bureaucracy's sake.
It's focused, it's high stakes, and it could impact everything from how you buy Bitcoin to maybe those DeFi apps you're exploring. It's really about building the rule book for what comes next in digital finance.
Yeah, and what's really fascinating here, I think, is that this isn't just some routine technical exercise for the CFTC folks. This crypto sprint, it's a direct response, a really concerted one, to a market that's just evolving at, well, an unprecedented speed. And it represents this intensified effort to bring structure where, let's be honest, there's often been a fair bit of ambiguity. So our mission today is to do a real deep dive into what these sprints actually are, why they seem to be happening with such urgency right now, the specific corners of the crypto market they're targeting, and crucially, the bigger picture implications, for regulatory clarity, for innovation, and really for every single person involved in crypto, whether you're an individual just starting out, maybe exploring DeFi, or, one of the big institutional players thinking about getting in. We'll look at the specific aims, which agencies are involved, because it's not just the CFTC, and what this all might mean for the future of trading digital assets, both here in the US and, frankly, globally.
Okay, perfect. So let's start at the beginning then. Let's unravel this concept. What exactly is a crypto sprint? Sounds sporty, but maybe not quite Olympic level. Yeah, it's definitely more strategic than athletic. In simple terms, a crypto sprint is basically a rapid, really focused initiative by a regulator, the CFTC in this case, its main purpose, to quickly gather info and, importantly, get public feedback on very specific parts of the digital asset market, usually the tricky bits. Think of it maybe like a specialized task force, the kind they assemble for a big national challenge. But this one's laser focused on crypto regulation, trying to figure out how to regulate it without accidentally killing off all the cool innovation happening. That's the goal, right?
Absolutely. It's designed to speed up understanding and policymaking in a sector that, as we all know, moves at lightning speed. Traditional rulemaking can take years, literally years, these sprints. They're meant to get answers and potential policy changes much, much faster. It's like the regulators are admitting, okay, our old playbook is too slow for this crypto stuff, which is actually kind of refreshing.
And this specific sprint, the second one they've done, it has a remarkably precise focus that's really key for listeners to understand. If we connect this to the bigger picture, this sort of surgical focus on leveraged retail spot trading isn't just random. It directly hits on core concerns around, well, consumer protection and market integrity. And those are right at the heart of the CFTC's job, their mandate. So to be specific, they're actively looking for public feedback on regulating stock crypto trading. But, and this is the crucial part, not just any spot trading, they're zooming in on transactions that are leveraged, margined, or financed, specifically when done by retail participants, so individuals like you and me, on CFTC-registered exchanges. That distinction is vital. We're not talking about you just buying some Bitcoin with cash on a non-leveraged platform. That's different. They're looking hard at the higher risk stuff where people are essentially borrowing money to make bigger bets, which naturally ramps up the risk significantly, right? Especially for folks who might be newer to crypto and maybe don't fully grasp how quickly things can go wrong with leverage in such a volatile market.
So this targeting, it really underscores a concern for protecting individual investors from, potentially devastating losses when those leverage bets sour. And they're not just watching. They've put out a very clear call to action. They want public input, feedback on these specific issues. And they've set a deadline, October 20th. That pretty tight turnaround signals they really want stakeholder engagement. They want to hear from the market before they make rules.
Right. And like you hinted, this isn't the CFTC's first time trying this sprint approach. This isn't their first rodeo, as they say. They actually did an initial crypto sprint before this one. Understanding that first one helps us see how their thinking is evolving. Sprint number one, that was more about laying down the basic tracks, like getting some initial infrastructure set up. It mostly focused on enabling spot crypto contracts, basically figuring out how to allow spot trading on derivatives, exchanges, things like that. That first sprint was important, no doubt. It opened some doors for new kinds of crypto trading, set some early boundaries. But now, sprint number 2, it feels like a definite shift of gears, you know? It seems less about opening totally new paths and much more about engaging with stakeholders and refining the regulations, which shows, I think, a growing maturity in how they're approaching this whole thing. It's like moving from just enabling something to now fine-tuning it, making sure the whole system runs safely and efficiently. And critically, making sure your input, the public's input, is part of that fine-tuning process. It's like building out the guardrails after the first stretch of road has been laid down and maybe driven on a bit. It shows they're learning and adapting, which, frankly, is good news in a space moving this fast.
Absolutely. And it's also really crucial to remember that this CFTC effort, important as it is, isn't happening in isolation. It's not in a vacuum. It fits into a much larger top-down strategy, which leads to that big question. Why is the White House so deeply involved in crypto? It's not just about keeping markets stable, though that's obviously part of it. It's fundamentally about establishing the U.S. as a global leader in the digital economy, ensuring that innovation happens here within the U.S. while also managing the risks that come with it. So these CFTC sprints, they're a direct response trying to fulfill that broader White House goal, U.S. leadership in crypto. And the strategic importance here is huge. The U.S. wants to lead for, well, several big reasons. 1, fostering innovation at home, right? Avoid losing talent or new ideas to other countries. 2, economic competitiveness. Digital assets are reshaping finance globally, so staying ahead is vital. And 3, there are significant national security angles, things like illicit finance or even the impact of other countries' digital currencies.
The White House sees digital assets playing a massive role in the future economy, and the plan is for the U.S. to actively shape that future, not just react to it. That means setting standards, building strong domestic systems, and creating a predictable regulatory environment that encourages growth, not pushes it offshore.
And it's fascinating because this isn't just some vague idea. It's a concrete follow-through on some really extensive work done at the highest levels. You can trace these sprints right back to recommendations that came out of the president's working group on digital asset markets. And that wasn't just a quick chat, right? That group did a massive review and came up with over 18 distinct proposals for a crypto framework in the U.S. But even that was part of an even bigger picture, outlined in that huge 160-plus page White House report. Imagine a 160-page report, not just saying here are the problems, but laying out this grand vision for a new digital economy with the U.S. leading the charge. That report really pushed for key things: definite regulatory clarity, building modern infrastructure for digital assets, and interestingly, creating these sandbox environments for innovation. We should probably talk more about those later. So that massive report, it isn't just sitting on a shelf, it's the actual blueprint for these CFTC sprints and everything else happening. It really shows a deep commitment from the top to proactively shape crypto's future here.
And when we connect that back, this push for regulatory clarity, it isn't just about rules for rules' sake. Not at all. The fundamental goal is to provide the confidence needed for, well, significant institutional investment and broader mainstream participation, to finally move past that Wild West image that crypto has sometimes had. So the aims of this clarity push are really threefold: unlock adoption, foster innovation, and ensure fair play in the markets. Think about it. When the rules are clear, big traditional financial players, the ones managing trillions, feel way more comfortable entering the space. That could mean a huge influx of investment, bringing more liquidity, maybe more stability, more credibility to the market. And for you, the retail investor, clarity means a safer, more predictable environment, less risk of scams, manipulation, or getting caught in some weird jurisdictional fight. The desired end state isn't just regulation, it's cultivating a mature, robust crypto ecosystem where both the big established players and the innovative startups can thrive, all while, protecting consumers and keeping the financial system stable. It's about building that level playing field where innovation is encouraged, but not at the expense of integrity or trust.
Okay, but you can't really talk about U.S. crypto regulation without hitting that elephant in the room. The history of confusion, especially between different agencies, just think back to the Ripple lawsuit with XRP. That whole saga was almost like a textbook case of how lack of clear rules and overlapping jurisdictions can just create chaos. The SEC versus Ripple fallout really showed the deep confusion between agencies about how to classify crypto assets. Is it a security, a commodity, something else? It left so many people just scratching their heads asking, okay, who is actually in charge here? That case really drove home the need for clear boundaries and for regulators to make rules before things blow up, rather than just reacting with enforcement actions afterwards. Those legal battles drag on for years, right? Casting the shadow of uncertainty over companies, investors, the whole market. So this sprint and the wider White House agenda, it feels like a direct attempt to fix that confusion, to define roles and responsibilities clearly up front before the next big lawsuit happens.
And what's really interesting, I think, is the admission from the regulators themselves that no single agency can fix this alone. The fact that Project Crypto even exists is kind of a tacit acknowledgement that they need a unified approach to avoid contradictory rules and provide a coherent framework. It's about bridging agencies in a very real sense. So to tackle that historical confusion and fragmentation, Project Crypto was launched. It's a key initiative specifically designed to foster coordination between the CFTC and the SEC. Their goals are ambitious, sure, but necessary. Harmonize their rulemaking and significantly reduce that jurisdictional overlap that's plagued the space. I mean, imagine trying to operate a business where two different sets of potentially conflicting rules might apply to the same digital asset depending on who decides to step in. It's a nightmare. The challenge, of course, is huge. You have two powerful agencies, each with its own history, its own mandate, sometimes different philosophies, now needing to work together on something totally new that doesn't fit existing boxes.
Project Crypto is really an effort to build a shared understanding, a common vision, and a consistent approach, so digital assets aren't caught in regulatory limbo or subject to conflicting demands. It's a delicate negotiation, no doubt.
Yeah, and to help listeners maybe visualize this, you could think of it like an agency divide heat map. Before these reforms, that map would be a mess, right? Lots of blurry lines, overlapping colors, especially where CFTC and SEC territory clashed over whether something was a commodity or a security, a real regulatory fog. The goal now, with initiatives like this Sprint and Project Crypto, is to simplify that map, to clarify exactly which assets fall under which agency's rules. They want to draw those lines much, much clearer. Make it easier for everyone, developers, exchanges, investors, to know where they stand without constantly worrying about stepping over some invisible line into a legal gray area. It's not just about tidying things up administratively, it's about reducing the ambiguity that leads to those super expensive, long legal fights. And, maybe most importantly, creating an environment where innovation can actually happen with more certainty. That's what the industry keeps asking for.
So what does this clearer picture actually look like in practice? It comes down to that fundamental question. Legally, what is crypto in the eyes of U.S. regulators? Is it a commodity, like gold, or a security, like a stock? It sounds simple, but the classification has massive implications. It determines which rules apply and who enforces them. So, a core part of achieving clarity, and a goal of these sprints, is defining crypto assets where it makes sense as commodities versus securities. The difference is huge, if it's a commodity. Generally, CFTC territory, subject to rules focused on derivatives, market manipulation, that sort of thing, if it's a security. That puts it squarely under the SEC, with much stricter rules about disclosure, registration, investor protection, more like stocks and bonds. These two agencies, as we've said, have different jobs, different laws they work under, different levels of consumer protection baked in. Getting clear definitions would provide enormous certainty for everyone. Developers building protocols, exchanges listing assets, investors participating, they could operate knowing the legal boundaries, instead of constantly guessing or reacting to enforcement actions.
This isn't just about avoiding lawsuits. It's about building a predictable legal foundation for the whole digital asset economy.
Okay, now here's where it gets really interesting, and maybe even more complex. DeFi. Decentralized finance. It's this cutting-edge space that honestly challenges how we even think about traditional regulation. How do you regulate something designed to be decentralized, often without clear intermediaries? The CFTC and others are focused on clarifying DeFi participation rules, and that's tough. DeFi often runs on automated smart contracts, right? Permissionless protocols. Not always clear, identifiable companies that regulators can easily talk to or hold accountable. This makes applying old rules, which assume a central responsible party, really difficult. So the goal here is ambitious. Provide clear guidance on how different players in DeFi, developers, liquidity providers, users can engage safely, protecting consumers without accidentally crushing the innovation that makes DeFi so exciting. It's a super delicate balancing act. You have to address risks like smart contract bugs, potential manipulation, illicit finance, but you also want to preserve that decentralized, permissionless nature that's core to DeFi's whole promise. This sprint is trying to bring some much-needed guidance to that, wild but innovative frontier, trying to build a bridge between traditional finance and this new digital world.
And building directly on what came out of Sprint #1, there's also this ongoing need to keep adjusting derivatives regulations. They need to properly fit the unique nature of crypto derivatives trading 24/7 globally.
When you look at the big picture, enabling that 24/7 trading for perpetual derivatives, that was a really significant step forward. Now the focus is more on refining those frameworks, making sure they're robust, but also flexible enough for new products and market structures that keep popping up. Crypto derivatives futures, options on digital assets, they just operate differently than traditional ones. They trade constantly across borders, often with way more volatility than traditional markets are used to. So existing rules designed for older assets and limited trading hours, they don't always fit perfectly. We already saw success with the 24/7 crypto derivatives approval from earlier reforms. That was a big deal. It set a precedent, showed the CFTC can adapt its rules for this always-on market. It demonstrated real progress. So now it's about continuing that refinement, making sure these markets are fair, transparent, resilient, while still allowing for the unique ways crypto operates.
It's an ongoing calibration.
Okay, let's unpack this next idea because it's really smart, borrowed from other areas. Regulatory sandboxes. Imagine a sandbox, literally, but for financial innovation. This is definitely on the horizon for crypto. Basically, these are safe, controlled environments where companies, especially startups, can test new crypto products or services. They can do it under relaxed but still supervised rules for a limited time. It serves two key purposes, right? Regulators get to watch these new technologies up close, learn how they work in the real world, and give tailored guidance, all without immediately hitting them with the full weight of existing regulations that might just kill the idea before it starts. We've seen this work really well in other sectors, like fintech, lots of examples there, and the expectation is that this crypto sprint plans to replicate that model, create a similar safe space for digital asset innovators. Like, imagine a startup building a new NFT marketplace with some really complex royalty system built into the smart contracts. A sandbox would let them test it with real but limited users under the regulator's eye. They wouldn't have to meet every single potentially unsuitable existing rule right away. It encourages experimentation, lowers the barrier for new ideas, and lets regulators write better rules based on actual data, not just theory. It seems like a win-win.
And this next point touches on something really fundamental. How do we make crypto less, intimidating and more accessible for regular people? The idea of unifying user-facing interfaces speaks directly to that. It's about aiming for a more consistent, intuitive, and ultimately clearer experience for everyone, from pros to total beginners just, dipping their toes in. Think about it now. Every exchange, every DeFi app, every wallet seems to have its own layout, its own jargon, its own way of doing things. That fragmentation can be super confusing, especially for retail folks new to crypto. And worse, it can lead to mistakes or even create security risks. The idea behind unification isn't necessarily to make every platform look identical, like some boring template. It's more about setting common standards, maybe best practices, standardizing terms for key actions, for important disclosures, for basic user interactions. A move like this could lead to much more standardized, user-friendly, and ultimately safer experiences across the board. The potential impact is pretty big. Less confusion could mean more adoption, lower barriers to entry, and really help bridge that gap between complex blockchain tech and the everyday users who just want to use it safely.
And it's so important to remember these aren't just abstract discussions. These sprints lead to real changes that affect the market. Remember Sprint #1. One of its biggest concrete wins was enabling that 24/7 crypto derivatives approval. That wasn't just good news for traders. It showed these sprints can actually set precedents for quick policy changes and open up real new market opportunities. Before that, trading things like perpetual derivatives faced a lot of regulatory hurdles in the US. The CFTC's work in Sprint #1 directly led to getting those markets approved and running, allowing trading around the clock, which fits how crypto actually works globally. So that's a solid example, right? It shows these sprints don't just produce paper. They result in actual policy shifts and create new possibilities for market participants. It demonstrates real, tangible impact.
Exactly. And to really gauge that impact, beyond just saying it happened, analysts are closely watching derivatives usage trends. They're tracking the volume, the liquidity, the adoption rates of these CFTC-approved crypto derivatives since they launched after Sprint #1. Asking questions like, has trading volume gone up significantly? Are more big institutional players coming in now? Are retail users finding these products helpful for hedging or speculating? That kind of data is gold. It shows the real-world effect of the rule changes. If adoption is high and trading is stable, it suggests the policy is working well. But if engagement is low, or there are weird market behaviors, it might signal that adjustments are needed, or maybe a different approach entirely. This data-driven feedback loop is absolutely essential for making sure regulations are not just passed, but are actually effective and adapt to how the market evolves.
Which brings us right back to you, our listener. Because your role in this is actually pretty powerful. This whole regulatory process, especially for something new like crypto, isn't supposed to be some secret backroom deal. The importance of public comment engagement in these sprints really can't be overstated. It's fundamental. The CFTC genuinely wants your feedback, and it can influence what happens next. Remember that deadline, October 20th, for the second sprint's feedback period. It's not just ticking a box, it's a real chance for you to weigh in on issues that directly affect how you engage with crypto. If you have thoughts on regulating leverage spot trading for retail, or on how DeFi should be handled, or just the overall direction of US crypto policy, now is the time to share them. We could even look at how many comments they got last time versus what they might expect now. It really highlights how public participation is becoming more and more important. Your input brings those real-world perspectives that regulators might otherwise miss. Your collective voice helps build better, more effective rules for everyone.
And what's truly fascinating when you step back is seeing this whole thing as a journey, not just random events, but a deliberate ongoing process. From that initial executive order to the detailed working group report, the first sprint, and now the second one, it's a clear path. A path towards a crypto ecosystem that's more regulated, yes, but hopefully also more innovative because of that clarity. It's definitely not a one-off thing. It's an evolving, iterative process. We can almost visualize it as a timeline visualization, right? Mapping out the key steps. It started with the White House executive order setting the big strategy. Then the working group delivered its detailed recommendations. Then Sprint, #1, focused on enabling things like the 247 derivatives trading. And now, here we are, deep in the public feedback stage for Sprint #2, focusing on leverage retail spot trading. Seeing it laid out like that really helps put the current sprint in context. It shows it's part of a deliberate, systematic effort to bring clarity and predictability to this incredibly dynamic market.
So, wrapping things up, what does this all really mean for you listening right now? We've gone deep today into the CFTC's second crypto sprint, unpacking its pretty ambitious goals. We've covered everything from defining crypto as commodities, maybe, to creating those innovative regulatory sandboxes. It's all part of this bigger effort to create a clearer, safer, and ultimately, a more dynamic future for digital assets here in the US. This sprint is a really significant step towards getting that regulatory clarity, especially focusing on that riskier area of leverage spot trading for retail folks. It ties directly into those wider White House goals for U.S. leadership in the digital economy. And crucially, it shows that ongoing collaboration with the SEC, trying to bridge the gap and harmonize the rules, the big picture aim, to move from that old world of confusion and reaction to one of proactive, clear regulation that actually helps innovation while protecting consumers.
And that brings us to a final, maybe provocative thought for you, our listener. Given everything we've discussed, the detailed planning, the sprints, the collaboration, do you actually think this sprint approach is the best way to achieve real, lasting regulatory clarity for crypto? Or is there maybe a risk it ends up being more about showing action, a bit of political theater, without delivering truly deep, long-term solutions? And playing hypothetical for a second, if you could send just one suggestion to the CFTC before that October 20th deadline, what would be your absolute #1 priority? Would it be that clear commodity definition, specific rules for DeFi, or something else entirely you think is critical for the market's future? Your perspective really does matter here.
Absolutely. And if this deep dive helped you make sense of the complex world of crypto regulation, maybe gave you a few of those aha moments, please take just a second to like this deep dive, subscribe to our channel if you haven't already, and definitely hit that notification bell. Your support honestly powers everything we do here at the deep dive. It helps more people find us through the algorithm, and it lets us keep creating this kind of timely, in-depth crypto content for you. And we genuinely love hearing your thoughts and insights, so please jump into the comments section below and share them. Thanks so much for diving deep with us today.